So today we are going to speak about the simplest strategy to make money in the stock markets. This does not require you to have any expertise in terms of stock market investments and what mutual funds are, what small cases are, what direct equity investing is. If you follow this one single tip and one single strategy, you will make money in the stock market. Right? What is that strategy? That strategy is called as rupee cost averaging. Now you might say that, Akshat, we have heard of this term. It is called as dollar cost averaging, not rupee cost averaging. Since we are doing it for the Indian markets, let's call it rupee cost averaging. If you like it, press the like button. Very quick shout out to our knowledge partners, Smallcase, for this video. Thank you so much. Without their support, this video would not have been possible. So let's jump right into the topic for today, and I'm going to speak about rupee cost averaging in 4 specific points. By end of this video, it will be clear to you what is rupee cost averaging, how to do rupee cost averaging in the right fashion, which instruments to use, and what are some of the things that you should do versus not do when it comes to rupee cost averaging / dollar cost averaging. So let's get started. Now first, let us understand that what exactly is rupee cost averaging, right? So it simply means that you pick up a certain budget. For example, it could be 10,000 rupees, it could be 20,000 rupees, it could be 5,000 rupees, it could be 1,000 rupees, anything, any number that you're comfortable making an investment in. You pick a date, right, on which you will make this investment, right? So let's say that you're investing 5,000, you pick a certain date of every month, or weekly also you can do that. Every Monday I'm going to invest 1,000 rupee in the stock market. Okay, so 2 things. 1, pick an amount that you want to do, 5,000, 1,000. Number 2, pick a date, right? Pick a date or a day. It could be every Monday, or it could be every 5th of the month, or it could be every 25th of the month. So what you are doing is very simple, that you are actually automating your investment. Automating your investment. Automating means that, hey, I have a system. Every Monday, stock market, 1,000 or 5,000 or 10,000 goes into the stock market. Done, right? Where it goes, we will discuss that subsequently. But essentially, you are automating your investments and you are getting into the habit of making investments. Now you might say that, hey Akshat, this looks like very risky, man. I don't know, I don't feel very comfortable around it. Can you please explain why this method will work? Okay, glad you asked. So let's say this is the Nifty 50 lifetime chart, and if you can say that, hey, if you are making investment, let's say monthly basis, right? So what you are doing is that whether the market goes up, whether the market goes down, you are putting in money. You are putting in money, right? You are putting it in a periodic manner, be it every Monday, be it every 15th of the month, be it every 25th of the month. You pick a date and you pick an amount, and you keep making this investment. So in the long term, what is happening is that this Nifty 50 is actually going up, right? So what are you doing? You are actually averaging Nifty, right? You are averaging Nifty. So in the long term, your money will increase. Okay, your money will increase and it will mirror what? It will mirror Nifty returns. If you are doing rupee cost averaging in Nifty, it will mirror Nifty returns. So you might say that, hey Akshat, okay, this looks fine, but can you explain like another advantage why this method works? Okay, so let's say that we are making periodic investment. There is no timeline to this period. It can be once every month, it can be once every week, it can be once a year, it can be once every decade, right? It doesn't matter. But my recommendation is that at least do one periodic investment every month at least. Periodic investment every month, right? Okay, so back to this Nifty chart. Now, let's assume that there are 3 investments that you make of equal amount, right? You make one investment here when the market was low. Market fell down. You said that, okay, hey, let me make investment. You made it, right? Let's assume that you invested 10,000 units here. Then the market stabilized, right? You said that, okay, you know what, let me make another investment, right? So you invested the amount here when the market was low. Now let's assume that this is a 1 month period, and after 1 month, you invested another amount, right? 1 month period, you invested another amount of 10,000. Now this is 1 month again, and let's say that you made another investment somewhere here, right? So what is happening is that you invested in the market in a periodic fashion, that the market fell, you invested 10,000, right? So will you buy more units here compared to this? The answer is yes, right? Because the market is low, so therefore you buy more units of stocks or more units of Nifty. Let's assume that you were able to buy 5 units of Nifty. So discount all the pricing and all that. I'm just explaining it to you mathematically. So let's assume that you are able to buy 5 units of Nifty here, right? Now the market has stabilized. Now you are again investing 10,000 rupees only. So will you buy more than 5 units or fewer than 5 units here? The answer is fewer than, right? So you might end up buying 3 units. Now the market is even higher here. So do you buy more units or fewer units compared to the previous data set? So fewer units, right? So essentially, so you invested or you bought more units when the market was down. So this is the magic, and this is the reason why it works if done consistently over time. So if you are making small periodic equal investments over a large period of time, you will reap the averaging benefits. You will end up buying more units when the market is falling, and you will end up buying fewer units when the market is rising, right? So please keep this in mind. This is what rupee cost averaging or dollar cost averaging means. This will give you returns without even tracking the market. You don't need to use any brain in terms of automating your investment. So moving on to part 2, very quickly recapping what are the advantages of dollar cost averaging or rupee cost averaging. Number 1, it is the simplest strategy, so you can easily execute it. That's 1. Number 2, it gives you long-term compounding benefits because you end up buying more units when the market is down and you buy fewer units when the market is up. So by default, your returns will increase from that perspective. And number 3, you are keeping the emotions out, because many a times we try to time the market. We say that, you know what, the market is up. Let me just hold my investment. Let me just put it in the bank. Let me not do anything with it. Market will fall after a few months. Then I will invest. Great, but timing the market is very, very tough. What's the guarantee, right? The market has been trading right now. We are sitting in end of July. The market has been trading at approximately 15,800 levels. Is there a guarantee that it will fall below 15,000 levels? If you wait for 3 more months, if the market goes to 16,500, then what? That you have missed investing in the growth from 15,800 to 16,500. So this becomes a massive problem for you. So keeping the emotions out and not timing the market works really well if you're doing dollar cost averaging or rupee cost averaging. Now this brings me to section 3. In what instruments you should do dollar cost averaging? So number 1, let's consider bad stocks or penny stocks. So let's consider bad stocks or penny stocks. Now please don't do dollar cost averaging here or rupee cost averaging here, because what you would end up assuming is that, hey, this stock is really good. It is falling down, so let me put money regularly on this. And if you would have made regular investments on this stock, is it giving you growth? The answer is no, right? It is still becoming and coming to zero eventually, right? So the first key tip where you should do dollar cost averaging is that you must do rupee cost averaging on stocks that are fundamentally strong, right? Please make a note of this. Don't go and buy a stock just because it is falling, right? You might end up trying to catch a falling knife, right? When the knife falls and you try to catch it, you might cut your hand. So please don't do it. This does not mean that you should not buy fundamentally sound stocks when it is falling, right? Let me illustrate it by using another example of Bajaj Finance. Now, if you pick fundamentally strong stocks, for example, let's say that you are making regular investments in Bajaj Finance and all these red dot indicates that you actually ended up investing money on regular fashion in a fundamentally good stock, then in the long run, what is happening? In the long run, the average still stays positive, right? Because this is the trend line, right? You are buying more stocks in this region because of the concept that I had earlier explained to you, that if you are investing 10,000 rupees in Bajaj Finance every month or every week during this period, you would have ended up buying more stocks, right? Compared to this period, right? So on an average, your return is high. So the key principle of dollar cost averaging is that you must only do dollar cost averaging on fundamentally sound things, fundamentally sound stocks. If you are doing it on bad stocks, it's really bad. In fact, what you should do is that if you're trying to do rupee cost averaging on good stocks, you must buy even more amounts. So rather than investing 10,000 rupees, if every red dot indicates 10,000, you must invest 20,000, 30,000, right? When the stock is falling. So that way you get even higher returns, right? Why would you be doing it? Because you know that this is not a falling knife, right? This stock will come up when the circumstances improve. So I've used this strategy on Bajaj Finance, made a lot of money. So therefore I'm sharing it with you. I tend to make regular investments, whether the market is up, whether the market is down. I will always buy and I will always sell, because in the market there are always good money making opportunities. Now the second way in which you can do rupee cost averaging is that if you do it in small cases. But here please note down and please make a note that only do it for low risk portfolios, right? Why is low risk portfolios? Because these low risk portfolios and low volatility things, low volatility portfolios, in the long run, they will go up only. The second way in which you can do dollar cost or rupee cost averaging is that you can go and invest your money in periodic basis in industry, theme wise. So if you believe that 5, 10, 15 years from now, the rural demand is going to go up and the rural sectors in India are going to exhibit massive growth, then you can invest in this small case called as rising rural demand. So you are making a thematic investment on a periodic basis, right? You can make a thematic investment on a periodic basis. All you need to do is that go on invest now, and you can do a monthly SIP, right? You can just literally press this button and you're done. All you are betting on is that you are betting that, hey, the rural demand going forward will go up. I'm bullish about this particular industry sector. Therefore, I'm making monthly small bets on it. Similarly, if you feel that, hey, I can go and invest my money in electric vehicle sector, I see that sector or that theme growing massively in popularity in the next 10-15 years, go and do rupee cost averaging on it. That will still benefit you. So all you need to know is very simple that, hey, where the growth is going to happen, you're just picking up that area and investing your money. Now, the final way is that you can literally buy passive mutual funds, right? Passive mutual funds. These are Nifty 50 funds, Nifty 50, Sensex funds, Sensex based mutual funds. You can buy it from any company, HDFC, Bajaj, etc., and just invest in index funds. So every week or every month, you are making a periodic investment in the entire India's economy, right? This is what is happening via passive mutual funds. So I've showed you 3 ways. Number 1, stocks. What are you doing via stocks? Please don't try to catch the falling knife. Only invest in fundamentally sound stocks that you are confident about. That is method 1. Method 2 is that you can pick up a theme at rural demand or electric vehicle and make small case investments via that. And number 3, you can make investments in passive mutual funds, literally investing in Nifty or Sensex. Any of these methods would work for you. Which method is better, which method is worse, you have to decide. But these are 3 options that you have. Now, depending on your risk profile, how much money you are investing, you can bifurcate it in any of these 3 methods and start making your investments. Now comes the final question and the 4th part of this video, that how am I playing this out? Am I making monthly investments? Am I making weekly investment? Am I making lump sum investments? So I am currently doing all 3 because the market now is stabilizing or is going up. That is the assumption that I have. So market is not going to fall massively from this point on. So I am going to continue to make periodic investments now via small cases, via mutual funds. And I have identified a few select stocks that I am going to keep investing in. They are trading at a decent price as of now. If you want, I'll reveal those 3 stocks, but please don't take that as an investment advice. Do comment if you would want me to make a separate video on that topic, and I'll do the same. So I hope you enjoyed the video, and I will see you the next time.